Friday, December 16th. Mark Milam here, your mortgage professional with Highland Mortgage. Let's get right to it. A really good week.
All right, high five. All right, high five. All right, high five.
For what we knew were going to be two huge days in the market. We anticipated that Tuesday of this past week was going to be a big market mover, lots of volatility, thanks to the report from the Consumer Price Index. We got great news there showing that month over month, inflation continues to moderate. Now we're still really high. We're still at 7% year over year inflation, but we're trending in the right direction and we're coming in lower than expectations. We followed that up on Wednesday. The second big report was the Fed's announcement for the Fed funds rate. The Fed offered no surprises, keeping the Fed funds rate increase at 0.5 point. That's what was widely expected by the markets. And the markets responded favorably. Contrary to some popular opinion, mortgage rates actually improved on the day, even though the Fed funds rate went up by 0.5 point. That's simply because the Fed didn't surprise anybody, not with their language, nor with the rate move. Two very welcome events which kept rates either stable or improving depending upon coupon throughout the week. So we're finishing up this week a little bit better than we started the week, and hey, we'll take that. Let me flip the screen around here to show you what I'm talking about. So this was Tuesday, 12/13. This is the CPI, Consumer Price Index, month over month, coming in at 0.1 versus expectations of 0.3. If you strip out food and energy, we came in just slightly under expectations at 0.2. There on Wednesday.
Guess what day it is? Mike. What day is it, Mike?
It's hump day.
Woo-hoo!
We saw the Fed raising the Fed funds rate by 50 bips. And then we can see over here on 12/15, this is Thursday, retail sales coming in sharply lower than expected here, even though initial jobless claims were lower than anticipated. When you take in the New York manufacturing number along with retail sales, really a slowdown in the economy, and that should help get inflation under control. So if inflation's getting under control and the economy is trending in the right direction, the direction the Fed wants, why is the stock market selling off? So we've seen over the past couple of days some pretty sharp sell-offs in the stock market, and really where this is coming from now is this sort of baked in idea that traders and investors are starting to have that, boy, the Fed's not going to take their foot off the gas here. They are likely going to keep the Fed funds rate elevated, and that gives us a greater probability of pushing the economy into a recession. Stocks don't like recessions, right? That we're going to see some shedding of value if we do go into a prolonged recession, and that's what the markets are fearful of. When I say the markets there, I'm talking about the stock market, not necessarily the bond market. So we're back to this more normal dynamic of seeing bonds start to improve, but stocks are deteriorating. So why do the markets feel this way? Well, if you know anything about our Fed Chairman Jerome Powell, he probably has a poster up in his bedroom of Paul Volcker. That's the Fed Chairman who oversaw really one of the most inflationary periods in the United States history back in the 70s and 80s, and something that Powell is trying to avoid that happened back in the 70s. And this is what we call boomerang inflation, where you see this peak of inflation, the Fed gets it under control, and then you see it come roaring back. And that's exactly what happened in the 1970s. Let me show you what I'm talking about. So this is the 1970s here, this orange line, and we've overlaid that with inflation today. And you can see what happened here back in 1972 or so. We saw inflation start to peak, and then we saw it start to abate as the Fed cut the Fed funds rate, and then it came back with a vengeance here in the early 80s. So we had this two-humped camel here of inflation where we saw it peaking really high, and then it came back to bite us again. That's that boomerang inflation. The blue line is overlaid with today's data, so you can see how similarly we are tracking what happened back in the 70s. And what the Fed does not want is a repeat of this event in the next couple of years. We get this out of the way, I'll show you one other chart. So this is the Consumer Price Index. Hopefully you can see this back in the 70s, and we can see what was happening with inflation here in 1974, countries in a recession. Here we go down again, and then back up in the early 1980s, inflation peaking even higher than it was in 1974. The Fed is deathly afraid of this. In fact, if we overlay the Fed funds rate to this chart, let me make this a little bit more centered on your screen. The red line here is the Fed funds rate. You can see the Fed started cutting the Fed funds rate even before inflation had peaked back in the 70s. They are not going to do that this time, folks. So as we start to see this inflation number come down, those of you who are sitting around waiting for the Fed to start cutting the Fed funds rate in Q1 or Q2 of 2023, that ain't happening. The Fed is not going to do that. They've been very vocal about this. So even though the market is pricing in a little bit of better mortgage interest rates, don't count on the Fed cutting the Fed funds rate. They want to avoid this double hump, this boomerang inflation. So they are not about to start cutting the Fed funds rate. As a matter of fact, we're going to see the Fed hold the Fed funds rate pretty steady until they are assured that inflation is heading back down to their target range of 2%. So keep an eye on that. If I can help you over the weekend, don't hesitate to reach out. Mark.Milam at HighlandMTG.com. Thanks.